Hello there, Patriots, fellow taxpayers. Welcome to our program for today, where we are going to discuss the Internal Revenue Code 1031 exchange and the use of fractional ownership of real estate using Delaware statutory trusts. My name is Jason Pischel. I am Managing Director of Alternative Tax Management. And today's focus will be on the rules for Internal Revenue Code 1031. We're going to discuss the process, which is very technical and must be followed to a T in order to effect a tax-deferred exchange correctly. And we're going to close on some of the structures available for replacement properties. Let's start with the definition of Section 1031, which says, no gain or loss shall be recognized on the exchange of property held for productive use in a trade or business or for investment if such property is exchanged solely for property of like kind, which is to be held either for productive use in a trade or business or for investment. The foundation of this tax code was really to not penalize those that are running a business who have different circumstances where they might be exchanging different properties for other investment properties. But there's a lot to unpack in that sentence. The general rules say that it allows for the postponement of paying tax on the gain and depreciation recapture from a sale of property. The gain in a like-kind exchange is tax deferred, but it is not tax-free. We're going to expand on that in a little bit. If done correctly, and many of the clients that we work with, their end objective is to make it a tax-free transaction by leaving their beneficiaries a step up in cost basis. A lot of the transactions do end up being a tax-free transaction. And lastly, one must reinvest the proceeds in similar property as part of a qualifying like-kind exchange. So that term like-kind is a term where people get a little bit confused. And oftentimes people ask, well, I'm selling a multifamily property. Why are we talking about acquiring self-storage or student housing or industrial properties? Don't I need to acquire another multifamily property? The quick answer is no. So the term like kind really refers to the fact that you're selling an investment property. It's not your personal residence. It's not a vacation property. It's an investment property, and you're going into another property that's held for the productive purpose in business, trade, or investment, which could be multifamily, single-family housing, single-tenant retail, grocery-anchored shopping, industrial, warehouse, office buildings, and so on. Farmland, oil and gas assets, and also development, mineral, water, and air rights. So there's a lot of different flavors of replacement properties that can be utilized in a 1031 exchange. Specifically, what is not replacement property are stocks, bonds, or notes, other securities or debt, partnership or LLC interests, certificates of a trust, property located outside the U.S., that also comes up quite a bit. I've got property outside the U.S. Can I do an exchange? Quick answer is no. Real property or personal property, fixtures and different things like that. So I mentioned, the technical aspects of a 1031 exchange are incredibly important because there are no do-overs, folks. The IRS follows these different rules to a T, and if you don't as well, if you cross over deadlines, there are no ways to rescind a mistake or go back and file an extension. And so two timelines that occur upon closing of a property. The first is you have 45 days from the day of the closing to identify property that you're looking to replace your relinquished property. And then you have 180 days from the closing date to actually close on the property. It's important to note when you're looking at the calendar, holidays and weekends do count within that time frame. So you really do need to pay very close attention to the calendar. Critical to a transaction is a third party who's known as a qualified intermediary. Oftentimes, a qualified intermediary is an attorney. They don't have to be. There's a lot of large national qualified intermediary groups out there. And the three main aspects of what they're doing are, with the sales proceeds upon the sale of the relinquished property, it's critical that the seller doesn't have what's called constructive receipt of the proceeds. And what that means is the sale proceeds are not going in any fashion to the seller of the property. The qualified intermediary is setting up a escrow account where the proceeds go straight from the buyer of the property into that escrow account, and the seller has no constructive receipt of those proceeds. They can, however, take constructive receipt of a portion of the proceeds. A 1031 transaction is not all or nothing. And so if they sold the property for $1 million, let's say, and they only wanted to do a 1031 with 700,000, they're definitely able to do that. They would just be taxed on the 300,000 that they did not roll into the 1031. So in that instance, they could have the 700,000 sent to the escrow and the 300,000 sent to their personal bank account. Property identification. So the qualified intermediary needs to formally work with the seller to identify properties. And there is a special sheet that you fill out that names the actual title of the property that you're acquiring, the address of the property, the percentage of ownership of that property. And also at the end, during the closing, obviously, if the qualified intermediary has the cash sitting in their escrow account, they are very closely tied into the acquisition of the replacement property. So they are working with either a sponsor of a Delaware statutory trust, the advisor and the client that are looking to acquire the properties, and they are helping to fund that transaction. So a qualified intermediary, very critical to a 1031 transaction. And visually, this is kind of how the work flows. So I often picture closings. I don't know if it's done as much in the conference room of a law firm. A lot of it's done over the internet these days. But I picture some folks sitting around the conference table, signing those closing documents. The day of the closing, a wire, if there is debt involved, a wire would go to the institution that holds a mortgage on that property to pay down that debt. A second wire would then go to the qualified intermediary escrow account. And again, if the individual wanted to pull some money out of the transaction, a third wire could go to their personal account, whatever that dollar amount going to them personally is, they are going to be taxed on that dollar amount. Then the clock starts ticking, 45 days to identify replacement property, and that goes by super quick. I know a lot of people think that sounds like a lot of time, but I've worked with a tremendous amount of people doing these closings and transactions, and particularly if it's not just DSTs that you're looking to acquire on the other side. There's so many things that could make a transaction fall through when you're looking to acquire. 45 days is not a lot of time. And we're going to talk a little bit about Delaware statutory trust. Going into a transaction, ideally, we've had a lot of discussion and dialogue with investors who are interested in replacement properties, so that going into the closing, their mind is already wrapped around the concept, and perhaps even the properties are already picked out that they want to replace their relinquished property with. And so they go right from the close into the acquisition of these different properties. When the property is replaced, the qualified intermediary, again, they are the ones that are holding the assets in the escrow account, the equities in the escrow account. And so the qualified intermediary is sending a wire to fund the transaction. If it's a DST, those programs come pre-packaged with debt. If you need the debt, we're going to talk about that in a minute. Otherwise, the investor is also lining up financing through an outside lender who can add financing to the acquisition of the replacement property. Okay, so when it comes time for the identification, it does get a little bit complicated what the three rules are. The simplest identification rule is the 3-property rule. As the name implies, it means that you're identifying 3 properties. That's all there is to it. It's very simple. However, when you're using Delaware statutory trusts and a larger pool of assets that you're identifying, usually it's going to be the 200% rule, which allows you to identify as many properties as you want, as long as it's not collectively more than the value of 200% of the relinquished property. And then the third rule is called the 95% rule. We rarely come across the 95% rule. It's really more for folks that are acquiring portfolio acquisitions of real estate. And what the 95% rule stipulates is you can identify however many properties as you want, whatever the value is, it doesn't matter, as long as at the end of the day, you are actually acquiring 95% of the properties that you identified. So it gets a little bit technical there, not stuff you really have to worry about. That really is things that the qualified intermediary helps out with quite a bit. Again, so looking at the rules as far as the amount of property, equity, and debt that you have to acquire, that also is critical to trying to do a fully tax deferred transaction. And so the first scenario, talking about valuation of replacement properties, the first general rule is you need to acquire property of equal or greater value than the property that you're relinquishing. And so if you had $1 million property and you're trying to do a fully tax deferred exchange, you need to acquire another property of $1 million or greater. And then it further gets a little bit more detailed when you're breaking apart the components of what that valuation is. So usually there's an equity component, and a lot of times there's a debt component. For sure, there's always going to be the equity component, right? But a lot of times investors have paid off their debt, and so sometimes it's only an equity component. So let's dig into that. Let's unpack that a little bit. So from an equity perspective, the rule is you need to acquire the same amount of equity that you had in the property that you're relinquishing. And so if you had $1 million of equity and 400,000 of debt, you need to acquire at least $1 million of equity. And we'll talk about the debt in a moment. Let's do that one over. So say there was no debt, $1 million equity, and you're going into $1 million of property using the equity. You can add debt as long as you're maintaining the amount of equity that you had relinquished on the other property. When the debt comes into play, this gets kind of tricky. I often come across people that are thinking, I just had this happen with an investor that reduced their debt, which you're not allowed to do. The rule is you need to acquire the same amount of debt that you had on the property that you relinquished. And they thought since they acquired a property of equal value, so they had a property that was $1 million, and they bought another one for $1 million. They reduced their debt, and they basically went down to $800,000 total acquisition price, and they had to pay tax on $200,000. You can add additional equity to offset a reduction in debt, but you can't just reduce debt without adding more equity. I think I might have jumbled that one up a little bit. It gets a little bit tricky, but the general rule is try to stick with the same ratios or more of the property that you're relinquishing. If you're reducing your debt, you need to add more equity to offset the reduction of debt. You got to keep the same amount of equity. You can add debt on top of the same amount of equity, but you can't reduce that without adding equity. All right, so we're going to move on. What's the big impact? Why do you really want to do the 1031 exchange? Well, mainly because a lot of the folks that we work with are trying to generate an income stream. And so looking at the loss of your capital to taxes, typically you're going to lose 25 to 35% of your gross proceeds to taxes. There's federal capital gains tax, which will either be 15 or 20%. Net investment income tax, depending on the income sources that they have, could be 3.8%. A big one that a lot of people don't consider, if you owned a multifamily and for the last 10, 20 years, you've gotten a depreciation allowance on it each year, which is reducing the amount of income tax you have to pay. If you sell the property for a gain, the government comes back and says, well, wait a minute, we were giving you the benefit of the doubt and saying that the value was declining. And as you were collecting depreciation allowance, it's reducing your cost basis. And so when you go to sell the property, the government comes in and they want to recapture all that depreciation that you took. And so there's a flat 25% tax rate on the depreciation that you've taken over the entire hold period. And the last one, of course, the state's going to want their cut. And so if you're living in California, where we work with quite a few people that have made a lot of money in real estate, you're looking at, potentially over 13% state taxes. And so the bottom line is, if your objective is to maximize your income stream, you had a sale of that $1 million property, you paid a whole bunch of taxes, and now you've only got, let's say, $700,000 of net proceeds after tax. It's hard to generate the same amount of income stream based on the $700,000 that you would have if you use a 1031 exchange and you have the gross proceeds of $1 million going to work for you. And ultimately, if you're looking to generate the maximum amount of income and ultimately pass your property to your beneficiaries at a step up cost basis, a 1031 exchange is a great option. So enter Delaware Statutory Trust. DSTs came on the scene in the 80s. I really kind of call it the second generation of the tenant in common structure. Tenant in common used to be the prevalent structure, but there were a lot of different problems with the tenant in common structure. Mainly, the way I look at it is you had 30 people participating in a tenant in common structure who didn't really know each other. So it's a marriage of like 30 people in a financial transaction buying a piece of property, and you needed unanimous type, opinions and voting to get things done. And I think it really came to head around the 2008 meltdown in the real estate market, where you had people panicking and hitting the sell button, wanting to get out and exit properties as the values plummeted. And the ones that were savvy and wanted to hold on until the market rebounded, often, were outvoted by those that wanted to kind of hit the panic button. So Delaware Statutory Trust became the primary mode for fractional ownership for a lot of different reasons that we're going to talk about. It was established by the Revenue Procedure 2004-86. As the name implies, it's a trust that's structured in the state of Delaware for the purpose of 1031 exchange, and simply, view it as fractional ownership of real estate. But instead of pooling your capital with other investors where you all make the management decisions, you have a professional manager who's taking the lead and controlling the responsibilities of all the important decision making. So the sponsor acts as the sole trustee for the real estate closings. With one loan, one borrower, it's easier for DSTs to get debt on the properties because each individual, it doesn't tie to their personal financial circumstances. The lending agency for the DST doesn't have to worry about the individuals collecting, debtors coming after the property. There's kind of a firewall with the Delaware Statutory Trust entity. One thing that people like quite a bit when it comes to the debt is non-recourse to the investors, meaning it's not going to show up on your credit report. I haven't seen any circumstances where these DSTs have had significant hardships where the debt kind of failed, but if something were to happen, it never passes through to the individual investors where there's something like a capital call where they need to add other financing. That doesn't happen. And the last point, real quick, no need for separate LLCs like you did with the tenant in common structure. The Delaware Statutory Trust acts as that legal entity, so each individual doesn't have to create their own legal entity to invest in the real estate. All right, let's talk about some of the potential ownership structure benefits. As I was describing, the DST is a turnkey solution, a one-stop shop for real estate investment where you can get your prepackaged debt. The professional scouts out and finds the best growth marketplace to buy properties. They are managing the property over the lifetime of the holding, and they're seeking a exit strategy and timing that's suitable, hopefully for a profitable exit. But the DST as a structure really facilitates estate planning exceedingly well, because as fractional ownership, you're able to assign different share amounts to different beneficiaries. And so it makes for a simplified ownership structure when it comes to real estate. I often talk to individuals who own large portfolios of real estate, and although those individuals might have been really active and still very active in real estate, maybe they own 10, 20 different single family homes or whatever it is that they own, but their kids or their beneficiaries have no interest and no aptitude for that real estate business. So what happens upon the passing of the parent? Well, it's not a good scenario, because the first thing that the beneficiaries are probably going to do, regardless of the market conditions, is hire somebody just to liquidate those holdings. So we work quite a bit with folks that use the DST as a planning tool to aggregate those portfolios in passive ownership to facilitate the transfer to their beneficiaries. For personal use, a DST, people can acquire properties in a 1031, and down the road, they might need that asset for personal use later down the road. So you could kind of park your capital in a DST for a temporary period, exit in 4 to 7 years, go into, perhaps another property in Florida if you're looking at a condo, hold on to that property for a period of time until you want to use it for your personal use. Asset segregation. We work quite a bit with folks that are perhaps getting divorced. Maybe they own property in an LLC. Maybe it's a dentist practice that owned a property for their partnership. And ultimately, these folks want to segregate those assets. They no longer want to be tied together in the LLC. So one of the rules of the 1031 that makes it difficult is you need everybody in on the deal. Everybody needs to be on board and wanting to go into the 1031 exchange, because one of the rules is you cannot retitle the property under a different name. You can do it if you have enough advanced planning, like prior to a year before you're looking to do a 1031. The IRS really isn't going to see what's going on with that property. They're going to look back within the next 12 months. And so you can acquire the DST, whether it's a partnership or a husband and wife that had an LLC that perhaps is divorced at this point. And once you're in the DST, usually we recommend 2 years in the DST. And then at that point, because it's fractional ownership, everybody can go their different ways. Meaning, if it was 100 shares in the DST and it's 2 people, one can take 50 shares, the other 50 shares, and you could retitle it under your individual name at that point. And then when the property gets liquidated, you can go your separate way. One can cash out, the other can continue on with another 1031. So it really does work well with asset segregation. Potential investment benefits. So it is a passive investment. That's the first thing that people like. I get a lot of folks that, real estate's a very labor intensive investment if you're doing it yourself and you own properties. We call it the 3 T's: tenants, toilets, and trash. It's hard work. And so at some point, we find that people want to retire, or they want to hand the properties down to their kids or beneficiaries. But typically we find at some point a lot of folks want to kind of exit, but they don't know that there's an option out there that allows them to become passive. So they're going from active owner to passive investor. Most think that they just got to, the most passive they could be is maybe buy a Walgreens or a triple net property, but then they're still doing paperwork and managing the property to some degree. So it's really an educational process with real estate investors to get them to understand the structure and that they can actually roll into this from a 1031 exchange standpoint and be completely passive in the ownership. And there's other benefits that go along with it. Usually the properties that I run into that people have owned are within their local region. Makes sense. They like to be close enough that they can go kick the tires, so to speak, on the building that they own. Whereas the DST investors, the sponsors of these programs, they're not biased in any way to geography. Most of them kind of steer clear of the coastal areas just based on the pricing. And typically we see a lot of focus on, the Sun Belt, where there's still a lot of economic growth. And so they're focused more on the dynamics of the geography and the property. And so, with $100,000 investment minimum on these DSTs, you can diversify into a multitude of different types of properties that we're going to talk about. And through that diversification, perhaps you're getting an increased stability of cash flows. You've gone from your local geography to, with maybe 1 or 2 properties to a larger portfolio. We're also going to talk about UPREITs a little bit. But provides for greater diversification, increased cash flow potential, stabilized cash flow. And the other thing is perhaps you've exhausted your depreciation on your property. The DSTs could potentially increase the amount of debt that you ascertain on your property. Again, you can't reduce your debt, but you can increase your debt, and that could potentially allow for depreciation once again. And again, I mentioned the sponsors being on the lookout for the higher growth marketplaces. But the DSTs come in a lot of different flavors. We see all different types, all different, debt levels. Multifamily has been really kind of a core strategy of DSTs. The multifamilies are typically 350 unit complexes, resort style pool, clubhouse, fitness center. They're not just your, duplex and single family rentals that individuals typically buy on their own. These are larger complexes that usually are geared towards young professionals or retirees. Student housing, industrial properties are super popular right now. We've worked a lot with the life sciences properties on the industrial side, where they're outsourced manufacturing from the big pharma companies, and they also have some laboratory work that they can outsource. Small bay industrial properties, distribution warehouse centers from Amazon. We work with net lease properties, which also could fall under healthcare or retail. Net lease, I'm often thinking the Dollar Generals, the Dollar Trees, the Tractor Supply, FedEx distribution warehouses, the dialysis groups like Fresenius. So the net lease properties are pretty stable. It used to be, the scare was that the .com and the internet was going to do away with the brick and mortar. I think we're safe to say that the brick and mortar is not going away. And the benefit of the net lease in general is the tenant is responsible for the taxes, the upkeep, the maintenance. And it really is a lower type risk with stable cash flows. The last one that's on the screen here is self-storage. That's been actually one of the top performing real estate asset classes of the last few decades. And so, when you come into a DST, if it's a multifamily, it's usually one multifamily. But when you're looking at the net lease and like the self-storage, it's typically a portfolio within one DST. So, some of the self-storage portfolios that we've worked with, it could be 3 different locations in 3 different states. Each location has 800 units. So you're coming into a portfolio of more than 2,000 storage units just in one DST. So the opportunity for great diversification is there. So I want to talk a little bit about a strategy that's been incorporating into the DSTs over the last decade. My background, I was with some of these larger sponsors earlier in my career and kind of started heading down the path of working with real estate and ultimately 1031. I helped one of the larger sponsors today develop their DST platform, which really leveraged the UPREIT feature. It was a private real estate trust that they had that allowed you to roll properties into it. And the rationale for why it's technically called Section 721, the rationale for why Section 721 exists is you have these large real estate investment trusts that acquire properties that are diversified, large portfolios of real estate. The first thing is you cannot do a 1031 exchange into a REIT. I get that question quite a bit. You cannot directly do a 1031, sell a property and go straight into a REIT. You can do a 2-step process where you first enter the DST and then the REIT absorbs the property. But again, the reasoning why they made this 721 is REITs would come across folks that owned individual properties that they were looking to acquire into the REIT. And the individual was actually interested in exchanging some REIT shares for their property, which is a tax deferred transaction. Rather than receive cash for their property, they would go to the REIT and say, I will let you absorb my Walgreens property if you give me a certain number of REIT shares. It's technically operating partnership units in the REIT in exchange for my property. Don't give me cash, because remember the constructive receipt angle. If you give me cash, it's going to be considered a sale and it's not a 1031 and it's not a 721. I'm paying a tax if I get cash. But if they receive operating partnership units, they're not getting any cash. They're getting units in the REIT. And so these sponsors have gotten smart with their platforms, have a parallel 2 different platforms where one is a real estate investment trust that's absorbing all these DSTs over a number of years. There's one group that I've worked with that's been out there doing this for 12 years, and they've amassed about $5 billion in net lease properties. And so they keep absorbing more and more of the DSTs and getting larger and larger diversified with the REIT. And the DST, it is able to provide 2 different directions. You could either take them up on an offer to go into the REIT, or you could travel a path where, typically a DST is going to find an exit in 4 to 7 years. And at that point, you can either send your cash back to the qualified intermediary, do another 1031 exchange. We do that quite a bit. You just keep kicking the can, getting the cash flow, and ultimately leave the property to your beneficiaries. They get a step up in cost basis, no taxes ever paid. So it's a great way to permanently eliminate that tax. Or they can cash out at that point. But with the UPREIT, the enhancement that the UPREIT offers, and it's usually, doing it a few different ways. Some of the money might continue on that regular DST path, so they have that exit and can continue doing a 1031. And, some of their assets, maybe you do an UPREIT where typically it's 2 to 3 years into owning the DST. They come to you with a opportunity to exchange your DST shares for operating partnership units in the REIT. And at that point, if you take them up on it, you're now in this larger, more diversified, stable yield REIT. And another big benefit is you're receiving quarterly liquidity at that point. You need to be in the REIT for 1 year, but it allows you to have control over your exit timing and liquidation of shares should you want to. Now, it's all tax deferred up until the point you ask for additional capital. So let's use the example of someone who had $300,000 in the DST. They said, yes, I want to get my operating partnership units. I'm going to go into the REIT. I'm going to exchange out of the DST. Now they're in the REIT with their 300,000. And after 12 months of being in the REIT, they are tendered quarterly liquidity options. And so they could say, you know what, send me an additional 25,000. I kind of refer to it as a real estate checkbook. Send me an additional 25,000 this quarter in addition to my regular yield. Everything else remains tax deferred, and they're just going to pay their pro rata amount of tax on that 25,000 as they're pulling it out of the REIT. And so it creates a few different things. From a liquidation standpoint, you can stagger your liquidity events to control the effect of taxation. If you want to slowly draw down your capital so you're not crunched by a one-time lump sum exit with your real estate, you can do it over a number of years. Or, you know, with a lot of the folks that we work with, they like to have the option to access the liquidity, but really they're just looking to keep the income. And once their beneficiaries receive the REIT shares, they can hit the sell button right away, as opposed to a DST. They're going to wait the time frame until they find a liquidity event. So it is a great proposition. The negative, of course, there has to be a negative. The one downside, you know, is really there is no ability to do another 1031 exchange at that point. Your only way to exit the operating partnership units is to exchange it for REIT shares. Once it's exchanged to REIT shares, it's a taxable event. So you can't decide, you know, I want to exit the REIT and go into another property through a 1031 exchange. You can't do that. The REIT is your last stop. And so, you know, that's why I was referring to a lot of clients that we work with. They'll do some into the UPREIT. They'll do some continue on the path of the 1031. But realistically, you know, with a lot of the folks that we work with, it's hard to find a better singular investment than going into like a $5 billion diversified REIT. I mean, if your end objective is lower risk through diversification, stabilized cash flow, you know, the REIT option is really hard to beat. So we're kind of winding down a little bit here. I wanted to touch on the DST, what's referred to as the 7 deadly sins. So as opposed to a REIT or perhaps some real estate investments that you might have worked with in the past, where it's referred to as a blind pool. A blind pool means you come in based on the proposition of what they anticipate acquiring, but you don't really know specifically what properties ultimately will be in the portfolio. A DST, you know exactly what's in the portfolio, because once they close and start raising capital to new investors, once they format that DST structure, you can't add additional properties. You can't add additional capital contributions. You can't refinance it. You can't make major capital improvements. You can redo the pool area. You can redo the cabinets in the kitchens, things like that. But you're not adding a big wing onto a multifamily, you know, complex. The cash reserves can't be invested in, you know, other types of investments. It's got to be in cash. And so, you know, I actually look at these 7 deadly sins as protective, you know, things that really are in place to protect the investors from changes in the DST once they're in it. And additional risks associated with the DST, these are illiquid, folks. You know, it's real estate. So, you know, there's not a time where you're in it for 24 months and say, you know what, I'd like to cash out. The only ability to cash out is to wait until the DST finds a liquidity event, which again is usually 4 to 7 years on average, or go the route of the UPREIT and then you get quarterly liquidity after you've been in the REIT for a year. And so, you have general real estate risk and the other risks associated with real estate. It's real estate. So you have exposure to the general real estate marketplace. Before we sign off today, I know we're talking about 1031, but I did just want to mention opportunity funds as an alternate exit strategy that we see where, folks might have not followed that timeline to a T, or I can't tell you how many calls that I get where people, ask me, I'm super interested in the 1031 exchange. How do we proceed? My first question is, when's your closing? And I hear so many people say, well, it was last Tuesday. And it's like, well, then game over, because you're not doing a 1031 exchange. That needs to be set up in advance. However, the opportunity fund is an alternate exit strategy that I like quite a bit. It has completely different dynamics, but as opposed to utilizing a qualified intermediary, it's self-reporting, meaning when you sell an asset, and it can be any asset, could be real estate, but we often find people these days where they own NVIDIA or Apple or some type of highly appreciated stock, or maybe it's a personal business that they've sold, where it could be any type of capital gain rolls into the qualified opportunity fund. The first benefit is they do get a little bit of a tax deferral. So when they roll in the opportunity fund, the year they do that, the capital gain for that transaction falls off the current year balance sheet, and it resurfaces December 31st of 2026. So you do get a short term, short time frame of deferral. That's not the big benefit for the opportunity fund. Think Roth IRA. Look, I equate this directly to a Roth IRA for capital gains. Everybody loves Roth IRA, but they set income thresholds where you can't add to a Roth IRA unless you're doing a backdoor IRA conversion strategy, which we do a lot of that too. But with the opportunity fund, you're rolling your capital gains in. You're going into ground up development of real estate across the country. These are typically higher growth assets. The first thing they're doing is using cost segregation and depreciation. So once the properties are built and stabilized, you're getting income that's tax free. And the second thing is the big benefit after 10 years of being in the opportunity fund, any gains created by the fund itself are completely tax free. And so let's say you're an investor who put 200,000 into an opportunity fund. Over 10 years, it grew to 400,000. When you liquidate in 10 years, you get to keep the full 400,000, no tax. Plus, as we described, earlier with the real estate, the depreciation recapture, when you sell for a profit, you need to recapture the depreciation. No depreciation recapture on that income. So that tax-free income that you collect over your time frame, you get to keep all of it. So I didn't want to dig too deep in. I appreciate you, letting me talk a little bit about the opportunity funds, good exit strategy in addition to 1031. A little bit about our platform, Alternative Tax Management. We are a holistic provider of different tax strategies, three main categories: capital transition strategies. We talked today about 1031 DST, opportunity funds. We also work with charitable structures. Another good exit is for charitable remainder trusts and strategies like that. We are heading into our super busy season with income tax mitigation, where people realize they either are a high earner or maybe they've got stock options or different things that are elevating them in an isolated event this year. Oil and gas programs are super popular. In fact, please attend our webinar in September. We're going to have a webinar on the oil and gas programs. Discounted Roth conversion strategies are very popular. You can buy certain investments inside your IRA. They're purposefully devalued 40 to 60%. You convert at a huge discount, and then all the benefits to the different programs, the cash flow, the disposition events, come back into the Roth IRA completely tax-free. So convert at a discount, get the benefits tax-free. We have programs that are passive activity programs where you can match your passive activity gains with passive activity losses. And the last one that I'll mention, since we're talking real estate, tax credits is our third major bucket. If you haven't talked about tax credits, we should discuss those. It is fantastic for those real estate investors who are generating passive income with real estate. You could also work towards 100 hours of participation so that you can use these tax credits against any type of income, but without the active participation, it's only used for passive income. But it's a major deduction in a few ways. You get tax credits, you get accelerated depreciation, you get cash flow. It's probably one of the most impactful tax categories that we have. And typically your tax benefit between the tax credits and depreciation is probably 4 times your investment, coming back to you. So it's a great strategy for investors. And the last thing I'll just mention, we'd love to work with you on these different strategies. And, we come in as experts to discuss in an educational setting. We're very educational, just talking about the risks, the benefits, and the different factors involved. We have different illustrations that we could share with you and help you work with your clients to just reduce their overall tax exposure. With that, I would like to thank you for joining us today. Again, my name is Jason Pischel. I'm Managing Director of Alternative Tax Management. Please reach out, go to our website, alternativetaxmanagement.com, sign up for a future event, or you could schedule a free consultation, and we'd love to be working with you. Thanks again for joining.